I can explain the put feature of a bond. So let's start by talking about a call feature. So a call feature is advantageous to the issuer in a declining interest rate environment. So, I say, hey, this bond seems to pay me a little more than other bonds I've been looking at. And I say, well, that's not a coincidence. That's not a coincidence. There's a reason for that. And the reason for that is that this bond is callable. It's callable in 5 years at 105. So you do have some call protection. They won't call it away from you for at least 5 years. And if they do, they'll give you 105. I think that's kind of a prepayment penalty. And that's called call protection. Call protection consists of two things, time and price. And call risk is associated with a declining interest rate environment. And so if you want to eliminate call risk, you can buy zero coupon bonds, which are not callable, and you can buy treasury bonds, which are non-callable. But usually bonds have a call feature. Not all bonds have a put feature. You say, Dean, this has a higher price and a lower yield than other bonds I've been looking at. I said, well, I'm not surprised. This has a nifty thing to it. This has a put provision. This is really a nifty thing to be able to do, to put the bond back to the issuer. And this is a pretty nifty thing to be able to do in a rising interest rate environment. So if your bond pays 4% and there's a put provision, and that put provision is exercisable in 5 years, let's say, and brand new bonds of similar credit quality maturity pay 7%, you're going to put it back to the issuer and get a new bond. So put provisions are advantageous to the investor, the bondholder, in a rising interest rate environment. And that put provision can either come from the issuer, or maybe I work the bond desk at Goldman Sachs. And I say, man, maybe I'll add a put provision in these bonds to make them easier to sell. And so if I decide to add that put provision at Goldman Sachs, I then would have to go get a new CUSIP to distinguish the bonds that have no put provision versus the bonds that do have the put provision. So that put provision can either come from the issuer, or a trading desk, a bond desk, may add that to make the bonds more attractive and easier to sell. I don't think put features are as testable as call features. So for a mutual fund, how do bonds affect the NAV? Well, again, bond mutual funds are actually more dangerous than individual bonds. So if we buy individual bonds and interest rates go up, which they've been doing, I say, well, what do we care? Because we're holding the bonds to maturity. Yes, every quarter you get a statement, and if interest rates have been rising, it's going to show that the bonds are down in price. But, we're not selling the bonds. Our portfolio is immune from fluctuating interest rates. And it's immune because we're not going to participate in the secondary market. We're just going to hold them to maturity. Now, in a bond fund, if people haven't sold that correctly, remember this, very testable, there's an inverse relationship of bond prices and interest rates. And as we, I guess we know or should know, interest rates have been rising. And so that means the bonds within the bond mutual fund have been declining, which means the NAV is going down. So when interest rates go up, that affects a bond fund's NAV because it goes down. Now, the dangerous part is maybe people weren't sold that mutual fund correctly as a long-term investment. And now they start redeeming, right? Because in the bond fund, you don't have the choice to hold it to maturity. And now our bond fund manager might actually have to sell bonds to meet redemption requests. So the bond fund can actually be more dangerous than the individual bonds. I'm not saying don't buy a bond fund because you get diversification, you get professional management, but it is something you should know. By the way, that risk, interest rate risk in the bond fund, cannot be diversified away. You can diversify away credit risk by diversification, but you can't diversify or mitigate interest rate risk through diversification because it doesn't matter what fixed income investment vehicle you have. If interest rates are going up, it's going down. So I hope that was helpful on those two questions. That's what we're here for. I like that. That was some good content questions.